Not 6 years, not 6 months, 6 days. In May of 1984, executives at Continental Illinois National Bank watched in real time as billions of dollars disappeared from their balance sheet, wired out by panicked depositors in Tokyo, London, and Frankfurt who had never set foot in the bank's Chicago headquarters. They were watching a bank run happen at the speed of a phone call, and there was nothing they could do to stop it. Just weeks earlier, Continental Illinois had been considered one of the most aggressive and admired banks in the country. It had grown faster than almost any bank in America through the 1970s and into the 80s, chasing bigger loans, bigger clients, bigger returns. Its executives were proud of how fast they said yes to borrowers. Other banks turned away. That appetite for risk would end up being the exact thing that killed it. The rot started somewhere else first. A small, obscure bank in Oklahoma called Penn Square had been writing reckless energy loans throughout the oil boom, and Continental Illinois had been buying huge chunks of those loans, over $1 billion worth, without doing the due diligence a bank that size should have done. When Penn Square collapsed in 1982, Continental Illinois was left holding hundreds of millions of dollars in loans that were suddenly worth almost nothing. The bank's own aggressive growth strategy had made it dependent on the judgment of a tiny bank most people had never heard of. For nearly 2 years, Continental Illinois tried to quietly manage the damage. Executives downplayed the exposure publicly, insisting the bank was fundamentally sound. But rumors don't need to be true to be dangerous, and in the banking world in 1984, rumors could move faster than facts ever could. In early May, whispers began spreading through financial markets that Continental Illinois was in serious trouble. There was no single triggering event, no dramatic headline, just enough doubt, in enough places, at the same time. And once the doubt existed, the money started moving. Foreign depositors, corporate treasurers, and institutional investors who held large uninsured deposits at Continental Illinois began pulling their funds out within hours of each other, all around the world. This wasn't a line of anxious customers outside a branch. This was a bank run conducted entirely through wire transfers, invisible, silent, and nearly impossible to stop once it started. In a single week, more than $30 billion left the bank. Regulators watched the numbers coming in with genuine alarm because Continental Illinois wasn't just another bank. It was deeply interconnected with hundreds of smaller banks across the country who kept their own reserves parked with Continental Illinois as a correspondent bank. If Continental Illinois failed, it wouldn't just wipe out its own depositors. It threatened to drag down a chain of smaller banks across the Midwest that depended on it, creating a collapse that could spread through the entire regional banking system within days. This is the moment where regulators faced a decision that had never really been tested at this scale before. Let the bank fail and risk a cascading collapse through the American banking system during an already fragile economic period. Or step in and save a bank that had gotten there through its own reckless decisions, using public money to rescue an institution whose executives had chased growth without asking hard enough questions about where that growth was coming from. They chose to save it. The Federal Deposit Insurance Corporation, working with the Federal Reserve and the Comptroller of the Currency, assembled a rescue package that guaranteed all deposits at Continental Illinois, not just the ones insured up to the standard limit, but every single dollar, including deposits from large institutions that legally should have been exposed to losses. The government effectively took an ownership stake in the bank, injected billions of dollars in support, and kept it operating rather than letting it collapse. It was the largest bank rescue in American history at that point, and it sent a message that regulators would spend the next several decades trying to walk back. If you were big enough, interconnected enough, systemically important enough, the government would not let you fail, no matter how reckless the decisions that got you there. Congress held hearings. A comptroller of the currency admitted under questioning that regulators were operating under the assumption that the largest banks in the country simply could not be allowed to collapse. A journalist covering the hearings turned that admission into a phrase that has outlived almost everyone involved in this story: too big to fail. For the executives who ran Continental Illinois into the ground, there were no criminal charges, no prison sentences, no dramatic downfall in the way some of the other cases on this channel have ended. The chairman resigned. The bank was eventually absorbed by another institution years later. Life moved on for the people who made the decisions. But the precedent they left behind did not move on. It became a permanent fixture of how the American financial system operates, a quiet assumption sitting underneath every major bank in the country that would be tested again at a far larger scale 24 years later in 2008. Continental Illinois wasn't the biggest fraud this channel has covered. It wasn't the most deceptive. But it might be the most consequential because it didn't just cost people money. It rewrote the rules of what happens when a bank gets too big, too fast, and too careless with money that was never really its own to risk. If you want to see how this exact same logic played out on a scale 10 times larger, with a bank so entangled in the global financial system that its collapse nearly took the entire economy down with it, that story is coming next on this channel. Subscribe now so you don't miss it.